So 2020 is turning out to be an interesting year to say the least. I would say that the 20s in general is shaping up to be an interesting decade. But just think about it for a second with me. But we're not even halfway through the year and the economy has both been firing at all cylinders at one moment and at the very next we're talking about 36 million people on unemployment, stimulus checks and programs flying all over the place, money being printed at unprecedented levels in world history. And we're only just getting started. What's next, you ask? The bank's paying you to borrow money? Yeah, that could be next. But is that even possible? What, pray tell, could inspire this? Is there any way that you can take advantage? Will this lead to the hyperinflation and thus hyperstagflation nation that we're so fond of speaking about here on this channel? Stick around, pound that like button, and hit that subscribe and notification bell to find out. What's up, you guys? You're watching BTP Fusion. I'm your host, Derek West, lead software engineer, online business guru, cowboy bebop fanboy, and all-around good guy. On BTP Fusion, our main goal is to inspire you to take action on your business and personal finance using the power of technology. But enough about us, though. What's the deal with negative interest rates? Negative interest rates have been a phenomenon mostly offshore in European and Asian countries. But could they come here? Can they lead to hyperinflation and my coined term, hyperstagflation? Can they help you? Can they hurt you? Well, negative interest rates can affect you personally in two different ways, via negative interest rates and negative deposit rates. To understand this, let's start from the beginning. In the beginning, you need to understand what an interest rate really is. Interest rates are typically defined as the price paid to borrow money. For example, if you loan your buddy $100, typically you only expect that $100 back from him. You give him a term when you want it back, let's say in a month. When you get that money back, you have $100 back. But that $100 is worth less to you thanks to inflation. For now, that inflation is hard to quantify. If we get in a high inflationary or hyperinflationary environment, you will most certainly get a sense for this phenomenon. But a little bit more on that later. Back to our example. If you, however, borrow money from a bank, they're not going to know you as well as you and your buddy. So they're going to charge you an interest rate to use their money. If we use the same $100 example to keep the math simple, at the end of your term, let's say a year, you would owe the bank $102. The bank typically asks you to pay that back in installments as well. Depending on what you agreed to, the payments would begin immediately and would recur monthly until the sum is paid off. Again, depending on the terms you agreed to, what you owe might be assessed yearly, quarterly, monthly, and so on. And they would charge you the agreed upon percentage on the balance that you have yet to pay off. Clear as mud so far? Yes? No? If not, leave me a comment down below and I'll try and explain it more in the comments. But if yes, let's continue on as it's about to get wild. So you now have a grasp on what an interest rate is. So what on earth is a negative interest rate? Well, in our first example, the interest rate that you charged your buddy was zero essentially. He didn't have to give you any extra money for borrowing money from you. If you charged him a negative interest rate, technically you would owe him money. Or at the very least, he would owe you less money. So instead of $100, he would owe you $98. To go back to our bank example as well, if the bank charged you a negative 2% interest rate to borrow $100, you would essentially owe the bank $98 instead of $102. So what you and the bank have in common is that you both paid $2 to lend someone money. Kind of crazy, am I right? Now, negative interest rates are sort of a new phenomenon in the world of finance. Prior to the last recession, the Great Recession of 2008-2009, most or probably all interest rates were positive. That is, central banks set a rate for other private banks to borrow money from them, and those private banks in turn set a rate for you to borrow from them. You can think of a central bank as a money wholesaler in a manner of speaking, and the national and regional banks as money retailers, i.e. the retail banks borrow money from central banks and then they lend it to you. They make money on the spread between the interest rates that you pay and the interest rates that they pay to the central bank. And that rate typically was positive. You see, in order for a bank to make money, they need to charge you a little bit more than what they are borrowing for. After all, they are money retailers. So what on earth would prompt any bank to charge negative rates, i.e. pay you to borrow money, or in reality, pay a central bank to borrow money? Well, in reality, it's the economy, stupid. You see, the main function of most central banks the world over, and particularly our central bank in the USA, is to ensure the health of the economy by maintaining a healthy money supply. I believe maintaining the value of the dollar is in their charter somewhere, but they apparently lost that clause a long, long time ago. So basically, in the minds of many politicians and central bankers, sending interest rates to zero was typically the last bullet in the chamber, so to speak, to keep the economy going. Apparently, the option of opening up the economy and letting businesses do their thing was not among the finalists in the How to Keep an Economy Going sweepstakes. In the Great Recession of a couple years ago that I just mentioned, Sweden's central bank was the first to utilize negative interest rates when they deployed them on July 2009. The Riksbank cut its overnight deposit rate to minus 25%. The European Central Bank, the central bank for the European Union, followed suit in June 2014 when it lowered its deposit rate to minus 0.1%. And I mentioned other European countries and Japan have since opted to offer negative interest rates, resulting in $9.5 trillion worth of government debt carrying negative yields in 2017. But if you're like me, you're probably wondering still, why? It sort of doesn't make any sense. But then I thought about it, and it sort of does. Let me explain why. If you understand a central banker's deepest, darkest fears, you'll understand the motivations for why they might want to consider negative interest rates. You see, central banks and central bankers fear deflation over all else, even if it means inflation, even if it means hyperinflation. You see, the prevalent theory among most learned, Harvard-educated central bankers is that the reason the Great Depression was so great and so depressing is because of the deflationary spiral that occurred in it. And if you weren't confused enough by this video, let me help inspire even more confusion by talking about deflation. You see, economic terms can be confusing, mostly because they are sort of opaque events that seemingly are unrelatable to the average person. But in reality, they don't have to be. You see, in deflationary spirals, what is happening is that the money supply is either staying stable or shrinking. Keep in mind that an economy is really just people trading goods and services with one another. People typically do this with money. As more and more people get into the economy, if the supply of money available to trade with stays the same or decreases, it becomes harder and harder to engage in economic activity. You see the effects of this in the forms of shops and businesses cutting prices, wages, laying employees off. You also see this when people don't borrow money to pay for houses, cars, home refinances to pay for other extravagancies like vacation, home remodeling, purchasing another rental house, things of that nature. Now, whether or not those are good things is a matter for a separate video, by the way. Like and subscribe. The problem is that people tend to hold on to their money as long as they possibly can and hoard it when they perceive scarcity around them. In a vacuum, that's not a bad thing, but that starts a deflationary spiral, and it typically only gets worse before it gets better. The fear among central bankers is that deflationary cycles will get worse and worse and worse until there is no economy left, just people bartering with beads or scrapes of food. Thus enters in negative interest rates. Negative interest rates don't just affect the interest rate that you pay, it affects how you store your money. In previous videos, I talked about how just putting your money in a savings or checking account is essentially one of the worst things you can do with your money, besides spending it on Lamborghinis and caviar. That is, neither of them are paying you an interest rate at least above the rate of inflation. Well, negative interest rates on deposits means this is doubly true, as now banks will charge you to put money in a savings account. And again, it all goes back to central banks. In Europe, central banks charge institutions that borrow from them, usually regular banks, money to deposit their cash. The local banks then pass that cost on to you, sometimes and not always, in the forms of charging you to place your money in a deposit account with them. So they are essentially charging you rent on your bank account. The question then becomes, how is this supposed to help the economy? To understand why some economists think it could help the economy, think of the two immediate reactions that negative interest rates and bank deposit fees would cause among banks. Because interest rates are negative and people are getting paid to borrow money, and because they are essentially getting charged to save money, the hope is that it will encourage people to borrow more money and save less, thus keeping the velocity of money high and keeping people spending cash. Will this sort of behavior cause inflation? Hyperinflation? Well, depends on who you ask. A lot of economists think that it will keep inflation at bay, believe it or not. Remember, central banks are charging other banks to hold their money. In other words, charging banks rent or a storage fee, quote unquote, to put their money at the Federal Reserve. So while they are encouraging borrowing, the money supply might stay the same or shrink because of that phenomenon. Also, since a bank's number one product are typically mortgages, and those mortgages are generally tied to the prevailing rate, every time an interest rate cut happens, you see a lot of ads to refinance your mortgages. Negative interest rates could squeeze the profit margin on those mortgages to the point where banks are actually willing to lend less, meaning less and less money circulating in the economy. And what's more, it encourages people to not put their money into banks, for long periods of time anyway. Meaning that people will either just use their money to buy frivolous trinkets like Lambos and caviar, or it could encourage people to take the money that they have and to invest it in new enterprises, or stocks, or bonds, or real estate. Will negative interest rates happen in the US? Well, we came ever so close when the Fed cut the benchmark interest rate 0 to 0.25%. And Fed Chairman Jerome Powell has said that if everyone's favorite beer-flavored flu comes back for round 2 in the fall, he may consider doing what has not been done before: negative interest rates in the USA. Now that said, interest rates in B2B Fusion have been going up recently if you haven't noticed. We recently rocketed past 1,000 subscribers and we're fast becoming a YouTube channel to reckon with. I reckon you might want to subscribe and hit the notification bell to be alerted when more great content just like this comes out, because we drop great videos weekly. And if you haven't done so already, be sure to hit that like and subscribe button so the YouTube algorithm knows who's boss. Let me ask you a question on this topic. If the US does get negative interest rates and banks pay you to borrow money from them and charge you to save money, will you pull all of your savings out of your local bank? Where would you put it? Stocks, real estate, other investments? Would you be more likely to borrow money in that instance? You see, inquiring minds need to know. So drop us a comment down below and we'll respond back with ways we think are the best to spend your cash in a negative interest rate environment. But remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take action on your business and finances using the power of technology. And we'll catch you next time. Peace.